Hey, what's up everybody out there in internet land? This is Mark Tomei from Hindsight Financial, and today we're going to talk about money. It's messy, it's complicated, it gives people anxiety, it keeps people up at night. But hopefully after today, I'm going to explain some things that are going to give you some aha moments to see things the way you've never seen before. And I'm also going to give you a couple better ways to chart your path from now until your retirement. So buckle up. Grab a snack, something to drink, and if you've got something to take notes with, let's get started. All right, so the financial system, let's talk. Very complicated, right? And a lot of times people think that it's stacked against us. Well, guess what? You're probably right. The system is designed by very sophisticated people, and it's not for our benefit. So if you've struggled along the way to prepare yourself for retirement, that's also not your fault. It's kind of been done that way to you. And if you feel buried under opinions and a mountain of information out there, you are not alone. It's getting worse by the day. So it's my hope to stand out in a crowd and give you some great information that you can deal with right away. So today I'm going to show you how we work with our clients to help them build private collateral, family banking strategies, retirement income, market-proof, tax-free cash flow. That's what we're going to be talking about today. What's the right way to do it? What are some of the mistakes that people make along the way that make it harder than it needs to be? And what's a good way for us to position our resources so that we don't run into the same problems everyone else runs into? So us versus them, Pink Floyd had it right. There's definitely two different camps, and the money system has been developed, as we said, by very, very sophisticated players, and they make it complicated for a reason. These people and these companies all benefit or profit from confiscating our money. We're going to talk a lot about that today. They're great at it. So this is what they do, and a lot of times we are in the unenviable position of just being knocked around by all of the different factors out there, and that fog of battle can really get in the way of making clear money decisions. So we've got some resources and a whole new way of looking at things to hopefully help you change the course that you're charting right now. All right, so I'm pretty picky and I'm pretty proud of this. I think it works great for everybody, but I also made a list of some specific audiences that I think might really get some extra benefit out of this message. And it really involves people that are trying to replace a higher amount of income in retirement. So the more income that we're trying to replace in retirement, the better this strategy works. So business owners selling their businesses, corporate executives who are in that retirement red zone within 5 years either way of their retirement date, doctors selling practices, entrepreneurs running their business in high tax brackets, and also we have some highly compensated employees. Again, anything where we're trying to replace a higher amount of income. And real estate investors who hate paying lenders and taxes. This is a favorite of real estate investors once they hear this message. So how does this apply to you? How does this apply to anybody who's listening to this message? Because we are all in different boats, no doubt about it. But we all face the same storm. So what's coming, and how are today's retirees in a different position than maybe any retiree in years past? We know that there are major stock market corrections built in and on the way. We don't know the exact timing. If we did, we'd all own our own private islands. But we are at all-time market highs, and the corrections are historic, and they come regularly. So we know that they're coming. And we're watching our nation's debt climb through the roof. Taxes not seen in our lifetime are probably on the way, and we need to be prepared for that. The regulatory environment, there's over 30,000 pages of tax code right now, and they continue to add to it. So the confiscation in the system from the sophisticated money managers and the financial institutions and the government itself, these are all places where your money is disappearing without value. So we're gonna point some of these things out, and I think a good place to start is just understanding some of the problems. We're at war. We're at war with our money. There's a lot of forces competing for our dollars out there, and information overload is alive and well, and trying to just get the straight scoop sometimes can be extremely difficult. And one of the things that I look at is how much control do we have over the situation? And when we're talking about building our retirement income, sometimes I think we might all be playing the wrong game, because if you look here at the factors that we can control, and then the two that we cannot control, think of where most Americans are saving for their retirement. Retirement plans at work, 401ks, IRAs, 403bs, 457s, the alphabet soup of qualified retirement plans. And guess what? They rely on policy and they rely on market returns, both of which are out of our control. So this will be the first one of, maybe we're playing this game the wrong way. So we're still talking people into saving their money in accounts that they have no control over and can't even predict what they're going to owe in taxes in the future. So why do we put up with this? I think sometimes it's just the flow of the herd. But I'll ask you a real simple question just to kind of set the stage for, are we a good fit to even continue this discussion? Let's say that the pie that you see on the screen represents all of the money, all of the wealth that you've cobbled together across your lifetime that will be used to provide you with financial security and income and legacy when you reach retirement. So if this pie represented all of that money, how much of this pie would you be willing or would you like to share with the government? Anybody ever asked you that question? I don't hear it enough, but I'm going to say for most of you, you're probably saying something to the effect of none of it or as little as possible. If you said one of those two things, continue on. If you had a number in your head of how much you wanted to give the government, this might not be for you, but we're going to keep going anyways. This is a critical concept, and I'm going to share with you why. Because when we talk about planning across decades, it's really important to know that just because something is today does not mean it will be in the future. So, into this, but the average tax rate at the top has been north of 55% for most of our lives. And only recently did we see reduced tax rates. And that kind of came at the expense of ballooning national debt. So, a couple facts to look at on here. In 1941, the top tax bracket was 81%. It's 81%, 81 cents on a dollar went to the government. Above the threshold. Well, the threshold at that time was $5 million. So, to be fair, not a lot of people back in 1941 were earning north of $5 million. But remember, we were fighting a war and we had debts, and it was important for us to pay our bills back then. 1944, towards the end of World War II, we watched the top tax bracket jump to 94%, and the threshold to reach that taxation was lowered to $200,000. So massive changes, and if somebody was counting on any degree of tax freedom, they lost it. Did you realize that we were taxing 94 cents on a dollar at one point in time? I want you to hold that thought, because it's still ringing in my ears. But if we look at how fast things are changing now, it's very eye-opening. So I'm going to show you on the screen here, we have the debt clock, our nation's debt. And in the top left here, I show you that back in 2000, the debt was about 5.7 trillion. And I still remember when it went over $1 trillion. That seemed like a big deal to me. Well, today, that number is north of $34 trillion. So that's a 6-fold increase in our credit card debt, for lack of a better word, from the government. And the money used to pay it, so our tax revenue, has only gone up by a little over double. So, can anybody see the problem that's starting to brew? I think we all have. So when we first talk about money and how to position our resources, going back to childhood, start young and invest your money or grow your money, compound, and in the future you will have millions of dollars. I remember being told that. Maybe you were told that. So I'm wondering, how did that work for everybody? Because what we did is we took this lesson of compound growth and savings early, understanding that compounding is the 8th wonder of the world, according to Einstein. But in the financial world, he missed one word there, and our good friend Brian Bloom picked it up, and the word is uninterrupted. So in order for the 8th wonder of the world to work, and for compounding to work, it has to be uninterrupted. Guess what the financial system and life does to us. It interrupts us systematically over and over. So here's a great example. We take our compounding lesson from start saving young and put your money away in a compounding account. And this is how we apply it. We put it in the stock market, in our 401ks or our IRAs. And this is the ride we get. So this doesn't look a whole lot like compounding. This looks more like an EKG. And you can see we've been up 100%, down 50, up 100, down 50. Our most recent run has been very aggressively bull market. So where do we think the next move is going to go? I could put this in front of a fifth grader and they would know the direction of the next trend. So very important to think that we are doing things that are making it harder on ourselves. This is an entire lost decade where you started and ended 10 years with the same amount of money because of what is going on in the market. Most people can't tolerate that degree in their retirement savings plan to have 10 years add nothing. So sometimes I think we're making a little bit hard on ourselves. Just one example. So we chase these rates of return around, and a couple things that exposes us to is wild volatility and swings in the market and our pricing. But when we're growing money, it's, the volatility is one thing. It'll impact where you end up. But for most of the ride, you're seeing pretty much the same thing. It's just later towards the end where the rates really make a big difference. If you're retired, now the rates and the order in which we get those stock market returns are the difference between finishing retirement with millions or running out of money early. So where you store your equity, where you store your treasure, your money, where you put that will dictate your life. It'll dictate how things happen for you. Volatility is relevant in a discussion for savers. It's life and death for the retirees. It can be a very dangerous place to have your money. See, in reality, we all kind of think that we earn what the stock market earns. And the reality of that is we can't directly invest into a market index. We can try to find things that replicate the indexes, but for the most part, what we're seeing here is all it takes is missing a few days in the market across that year, and it has massive impact on your outcome. So I think we just get a false sense of security when we start to assume that we can earn what the market earns. And to be really honest, most money managers don't consistently beat their own index. Consumers fare much worse. Consumers generally have investment returns in the 3% range, not the 7% range. So I think there's some inherent danger in assuming that you can earn what the stock market earns. We don't get to live on averages. Averages are fun for slides and classrooms, but we don't get to live that way. We get the reality. So how do we handle it when our objectives collide with those that we're doing business with? So these financial institutions have very different objectives than what you may have. So it's important for us to understand what drives the institutions. They want to take our money and they want to take it systematically, regularly, predictably, as often as possible. They want to hold on to the money as long as they can hold on to it because they're making use of that money in other ways that we're not even trained to do. And then they want to give it back to you as little as possible. So as much as possible, we have to understand what their objectives are because that's important in crafting our own plan. Just to give you a kind of a pictorial representation of how goofy it can be. So there's the whole universe of our investments that we own, and we have these in 401ks, IRAs, 403bs, whatever the case is. But understanding for many people, when you're paying advisors to manage your money, the 1% fee is a typical fee. They're actually a little bit closer to 2, but a 1% is easy to discuss. Comes off the top, comes off of the big number each and every year. And we all should know at this point that the account is not all ours, right? Out of all of this money, some of it's going to Uncle Sam. The funny part is that you will pay money managers an advisory fee to manage money that will never end up in your hands. It's going to go to the IRS for taxes. So it's almost like the IRS has hired a money manager to get free management of their money. Do you think that might be the case? So when we try to figure out how we spend our money, they tell us, and we're going to come back to this in a little bit, that we can take about 4% of our account each year. Because of this volatility, we have to limit our withdrawals to about 4%. And then when we do take that 4% out, Uncle Sam's right there to tax it. And you get to keep what's left over. So in this game, who looks like it's winning? Who looks like they're winning and who looks like they're losing? This is kind of a big picture of what we go through, but it brings to mind that confiscation is very real in our system. And I refer to confiscation as money disappearing from your world with no added value for it. So you didn't pay something for it. I'm okay paying money and getting something for it, but confiscation is a completely different animal. It's money leaving your world that you didn't have any choice about or knowledge of, and you didn't bring you any benefit. So the first one we'll talk about is Social Security taxation. And this will be a nice one because it could represent as much as $300,000 for a lot of people across their retirement. So that's a big number to hold on to. The next one we'll talk about is advisory fees. We've talked a little bit about that, but I want you to see the difference paying a fee, a flat fee for life, can have on your account. It's very eye-opening. Medicare premiums. You know, when we get out into retirement time and we put our tax returns together, if we have taxable income above certain thresholds, then we will pay more for things like Medicare than our neighbor who didn't have taxable income. And then there's also market losses. Obviously, you're not getting much from the market loss, but they can take a ton of money from you. And the key lesson here is a loss of half requires 100% to recover from it. A lot of people still haven't seen that 100% since they lost half in 2008. So, pretty big deal. And these are all voluntary. This is all because of where we put our money and how we chose to save. So Social Security taxation. A second tax on your dollar, right? Because if we all think about how we pay for Social Security, we earn $1, then we pay into the Social Security system with what's left over, after-tax money. The promise was we were going to get that money for free. And what we're finding out more and more as the tax system develops is they've figured out ways to tax the benefit. And I would call that a second tax on the same dollar. So there's a calculation. We don't have to get too crazy here, but I want you to understand that the way we figure out whether or not Social Security is taxed is through a calculation called provisional income. And in provisional income, what we're essentially doing is we're taking half of your Social Security benefit, and then we're adding our modified adjusted gross income, and we're adding back our tax-free interest. Now hold on, tax-free interest like municipal bonds and stuff like that, that's supposed to be tax-free, right? Well, this too gets added back into this calculation for a tax in another part of your world. You like that? I'm not crazy about it, and it's not even my money. So let's kind of look under the hood. This starts at $32,000. At $32,000 taxable income on your tax return, you expose half of your Social Security to taxation. If we're up in the 34 for singles and 44 for married couples, now 85% of our Social Security is exposed to taxes. And that was never the deal. So this is what I refer to as the 20% penalty that no one ever talks about. We all know the 10% penalty. Keeping your money, pulling it out of an IRA or 401k too soon. Everybody knows that there's a 10% penalty for that kind of thing. But what's the penalty for leaving your money in the plan and then using it as they designed it? And that's where we come up with another 20% penalty. And it's almost laughable because we fought a war with England over a 2% T-tax without representation. Now what we're seeing here is we're going to get two taxes on the same dollar with the full blessing of our representatives. So just a quick math on how that works. $48,000 of Social Security for the family. If we have over $44,000 on our tax return, 85% of our Social Security is now taxable. So $40,000 is now taxable. And if we assume a 25% tax rate, then that gives us $10,000. This is the tax bill that you're going to owe for your Social Security. And this tax bill is about 1/5 or 20% of the total Social Security award for your household. So we do a lot of talking about Social Security claiming strategies and when to take it and how to take it. And a lot of effort goes into that kind of planning, but very little goes into the fact that you're going to lose 20% of it right off the top because you have other taxes to pay on it. This is a huge one, guys. Make sure that you're very clear as to whether or not you're going to be in that boat, or if you're already retired, you might already be in that boat. Next one is advisory fees. Now, I'm all about people getting paid for good work, but our industry has kind of adopted this model where we use words like fiduciary and we tell the world that this is the best way to do it, and we're going to charge you money on all of your money every year for the rest of your life. That begs the question. So if we go back to talking about we can take 4% out of our account each year because of the volatility in the markets, so we're limited to about 4%. But if your advisor's charging you 1% in retirement, they're getting 25% of your retirement cash flow. I'm going to say that again. If you are planning to retire on a 401k, IRA, one of those types of accounts, where the idea is you built up a nest egg and now you have to spend a little of it each year, 4% is still the guideline. We're gonna talk about that in greater detail in a minute, but if you're paying your advisor 1 and you're only getting 4, we might have to rethink that strategy. Your advisor only needs 3 more of you and he can retire or she can retire. So maybe this is something that deserves a little bit more thought. Jumping ahead on our 4-year or 4% withdrawal rate, just take a look at the chart, and this is your withdrawal rate on the left. And these across the top are different portfolios. So the reason I start here 50-50 is for most retirees, 50-50 is a good place to start if this is the paradigm that you're following. Where they came up with 4% is they've done simulations on all the different market combinations of all these different portfolios and spending them down at these withdrawal rates, what percentage of the portfolios survived and which port failed. So what we came up with was at 4%, this was still a full 100%. Every portfolio made it without running out of money. This is kind of how the 4% rule got its rule of thumb name and how it's been adopted so heavily. But even the 4% rule today is under fire. It's probably more like 2.8. But I wanted to share with you from the perspective of the retiree. If I'm withdrawing 4%, I have a 100% chance of surviving retirement. But if I have to pay my advisor 1%, if I take it and add it in addition to what I take, which is what most people would do, my chance of success drops 47%. It's massive, just because we're paying a 1% fee forever. So the math of this, we cannot ignore. This is a business model that needs to be challenged. And I'm happy to do it. I used to do this. I no longer do this for this reason. And the average fee out there is about 1.56. So something to think about. Medicare, we also said if you put taxable income on your tax return, they're also looking for you to pay additional Medicare premiums. And this is called IRMA. And it looks at your income from 2 prior years to determine what penalty you have to pay. And these are additional costs per taxpayer. So if we're putting a lot of income, we've been successful, we put a lot of income on our tax returns, you could see that here is another spot where we could spend $500,000 per household per month. Now do that across a 30-year retirement. And we're talking about another $300,000 in addition to the Social Security money that went missing from taxes. So now we're up to $600,000. Now market losses we kind of already talked about, but if I lose 50%, I have to make 100%. That's the math of loss. And the reality is it's much easier to lose the 50 than it is to gain the 100. Just ask anybody who survived 2008. We tend to rationalize our losses. It's okay, we were doing this or that, but At the end of the day, yourself on your retirement day is going to not want to take excuses from your prior self for getting this wrong. We already talked about chasing rates of return and volatility's impact. I can't overstate it enough. It's life or death for the retiree if you are in the market. This 4% rule has been around since the 90s, and it basically just takes a look at, if I start with a portfolio and I withdraw it at a certain rate, how long does my money last? And again, I don't hear this talked about very much. I'm not sure if the consumer markets are getting this message, but for the most part, this 4% rule, like I said, even in today's market, is being challenged, being closer to 2.8 for today's retirees, based on financial factors of where we're starting retirement right now. So spending down, when we talk about the emotional journey of spending down retirement income, you've watched your account value rise your whole life. That feels good. Spending it down, now you have to watch the account values come down. And unfortunately, we don't get pretty charts like this in advance. We don't have anybody saying, here's when you're going to run out. You're winging it, and you hope it all works out. So this has been one of my biggest driving motivations, is to get people to understand the nature of the beast that they have put themselves in by using qualified retirement accounts and the stock market as the main source of where we keep our money. Small changes in spending here have massive impacts along the way. So it's very difficult to nail this down if we don't understand it up front. So I think we've beat this one to death, but just to understand, the 4% rule applies to 50-50 portfolios over a 30-year retirement. If we start getting into higher withdrawal rates, and I hear money companies all the time making claims that, well, we can get you more income, we have guarantees. These withdrawal rates are very real, and once we get past 5, nobody likes their chances of success anymore. So where we store money becomes a big deal. And I'm going to try to make it easy by saying there's 3 buckets, 3 places where you could store money, and I'm just going to categorize them by how they behave in retirement when you want your money. So bucket number 1 is always taxed. When you go to get your money in retirement, it's always taxable. Bucket number 2 is sometimes taxed. So that's an after-tax account where different factors determine what our tax bill would be. Bucket number 3 is never taxed at retirement when we get our money out. So if you had to guess, which bucket are we here to talk about today? Hopefully you guessed that right. Bucket number 3 is a big deal. So bucket 1, always taxed. With some examples: 401ks, all of your qualified retirement accounts. These are the ones that when you go to take your money out in retirement, you always have a tax due. People love these during their accumulation years, and I promise you they hate them in the retirement years. So please don't discount that. Put yourself in their shoes, in the retiree's shoes. You've always heard pay your dues, do the hard things, and good things will follow. In these accounts, we have not paid our dues. We have delayed our dues all the way till the end, and we've pushed our tax bill all the way out till retirement. This is a major stressor for retirees. Money spent from here can always create an income tax, but it can also create offsets and penalties for other areas of your tax return. So very important that you're using a tax pro to understand how all this works. A lot of people pay way too much for not understanding the rules of the game here, and mistakes can be very expensive. Bucket 2, we said, is sometimes tax. Well, what does that mean? These types of accounts are, you've already paid the tax on the dollar that you've put into the account, so when you take the dollar out, you will have what's called capital gains tax. And I'm assuming that capital gains is different from ordinary income, which it still is as of the date of this recording. But when we spend money out of bucket 2, that can also create offsets and other penalties. This contributes to our taxable income. So some of this will be taxed as income, some of it will be taxed as capital gain, and some of it will be treated as a return of our own money. Okay, so that's why we have to keep track of these types of things. And there's a lot of tax strategies available. There's nothing wrong with bucket 2. We like bucket 2. Bucket 3 is where the money coming out in retirement is not taxed. And so this is an example of accounts that people don't think a lot about while they're accumulating, but wish they had once they're retired. So hopefully we bring that to you today and create some aha moments. But these are different examples. Tax-free accounts, your Roth accounts, your Roth 401k, your Roth IRA. But then there's the tax-exempt accounts. And exempt is a really good word when we're talking about taxes, meaning these don't even contribute to your tax return. We don't even have to report most of these to the IRS. They're just exempt from reporting. So that's a good place to be. Money spent from bucket 3 creates no offsets that confiscate other benefits. So bucket 3 is where we're going to really focus as we go. And of the bucket 3 investments, the Roth IRAs, this beats the tax problem, but it doesn't beat the volatility problem. Still not necessarily the same thing as compounding. The tax exempt accounts, these are all ways where we accumulate money and then access the money via some form of loans. So a reverse mortgage, you're borrowing the equity of your home. Same with a home equity line of credit. Life insurance for properly designed life contracts, we can access the cash values and use those in retirement. Margin loans, if you have a big brokerage account, lots of money in it, you can borrow against your own securities. And then a commercial loan against commercial real estate. So these are all tax exempt ways of bringing money into the house. And those are where we're going to spend some time and focus. Exempt is the core of our strategy. I'm going to give you a quick illustration here with our buddies Huey, Dewey, and Louie. These guys got together and they decided that they wanted to nail down retirement, and they defined retirement as, at age 65, I want to have $80,000 of cash flow. Okay, that's a pretty distinct goal. And when we talk about goal setting, most people don't ever get down to that amount. I'd like to see my money grow. I'd like to be able to have this lifestyle. These guys said, I want $80,000 of cash flow, and we want to preserve as much of it as possible for our retirement. So they got together and they decided that they were going to do that. They didn't nail down who was going to do which bucket, but Huey decided to use bucket 1, Dewey decided to use bucket 2, and then Louie used our amazing bucket 3. And as you can see here, these are the amounts of money that had to go into each of these in order to generate the goal. So how did it turn out? If our gross spending in retirement is $80,000, in the bucket 1, when we take this cash flow out of our account, it's exposed to federal and state income tax. So the highest it could be at this time is 37.9. And I use this for illustration purposes. This isn't going to be the way it works out for most, but if you understand the gist of this, this will make sense to you. So $30,000, as much of that could be taken away in the form of federal taxes. And we've also created a trigger on our Social Security tax, which is $10,000. So when we take the money that we have to pay taxes on out of our cash flow, now all of a sudden we're down to $39,680. Dewey decided bucket 2 was going to be his way. So when he pulls his $80,000 out, we're going to make an assumption here that his accounts have about doubled over his lifetime. So when he takes his money out, $40,000 of it is going to be taxed at capital gain rates. And the other $40,000 is going to be a return of his premium, or a return of his cost basis. So he only has to pay tax on a portion of this money. But because he did, and because he had this income, he also triggered Social Security taxes, which in this case took about $5,800 away from him. So in our case, Dewey was left with $66,200. Now, how do we think Louie did? I know we remember bucket 3, $80,000 from his account produced no taxes, no offsets. 100% of his Social Security and Medicare are his without additional payments, premiums, penalties, watch-outs, or gotchas. And he gets to keep all $80,000. So we think Louie won this one. If you think Louie won this one, we're tracking. And the main focus on a bucket 3 type strategy for consumers. If you're healthy, life insurance offers this option, and it's abused, it's beaten up, It's poorly understood. It's been really abused by some bad actors in our space. But this isn't the type of whole life insurance your grandfather bought from the insurance store. These are specially designed contracts that are designed for output, and banks love them. So I want you to understand, banks carry a substantial amount of their, what they refer to as tier 1 capital, in the form of life insurance cash values. That's how good it is. If you want to understand it, understand that the banks treat this as their very best source of tier 1 capital. Okay, so if it's good for them, let's understand it for us. What do they know that we don't know? And when we use the life insurance strategy, the bucket 3 strategy, the build it and then access it via loans, it's the difference between taking from our account and borrowing against our account. And they're very different. So how does that work? If you withdraw money from your portfolio in retirement, that money is gone. That money is never coming back, and the growth that it could have, would have earned for you is also gone. So it's like pulling a tulip bulb out of the ground. No tulip's going to grow ever again from that spot. But what if we could keep our whole tulip patch and just borrow against it? And if we could find a financial institution that would give us an advance on our future tulip crop, wouldn't that be something? And this is kind of what we're talking about. But when I say loans, it probably puts something in your mind that, I don't like to borrow, I don't like loans, I don't like debt. But let me explain this differently. This is not a typical loan like you're thinking. This is not a loan where you have to go and apply. This is your money. You've built it. It's accessible to you. So we don't need applications. We don't need credit checks. And for a lot of retirees, it's not fun to check their credit early into retirement because they're still trying to figure things out, and they don't have the taxable income anymore. So there's a lot of watch outs when you first cross over into retirement and how you should be positioned. But from a loan perspective, no credit checks. There's no underwriter that determines, typically in a loan you have to prove you don't need the money before they'll give it to you. In this case, no financial underwriting, no scheduled repayment. This is the biggest one. These are non-structured loans. So when I take a loan against a life insurance contract, there is no coupon book that says, here's your first payment due, your second payment due, and the amounts. No, these are big boy and girl loans. We do not have to pay them back, ever. So the insurance company would be happy just to deduct it off of the tab at the end when you die. So there's a lot to understand about this strategy that has your interests exactly in line with the financial institution's interests. And remember from earlier, when we fall against their interests, we pay the price. So loans are simply subtracted from the death benefit when you die. It's really not any more complicated than that. They're easy to get. But the beauty of it is our tax code has enshrined them as tax-free forever. So this is right out of the GAO report from the government, specifically stating that loans against your future death benefit can be used as an untaxed current income. One more time. Loans against your future death benefit can be used today as untaxed current income. Now we're starting to find out why we like this so much. It's a triple threat. Insurance is one of the only things in the tax code where we have the triple threat of growing tax deferred, using it on a tax exempt basis, and then transferring it to our beneficiaries when we die, tax free again. This is why family legacies and dynasties are built from properly designed insurance contracts. So one more quick example of a retiree. We're going to meet Jim and Judy. They want to retire at age 65. So just a couple facts. They've had good income, but they've struggled while raising kids to save money. But they find themselves at age 50 with some cash flow available to save. So they've got about 15 years till retirement and about $37,000 a year available. Now, some things to understand about Jim and Judy is they are extremely uncomfortable with the stock market. They don't like the direction it's going. They don't trust it. And the other thing is they believe income taxes are going to go up and go up dramatically. This is important. These two things have to be present in your mind for this to work for you, because this is what this is all about. We're beating the volatility game, and we're beating the tax game. So let's look at how this works for them. In the years of age 50 to age 65, setting aside $37,000 per year means that they have sent in $557,000 to the insurance company for their contribution into this. And at the end of that time, people call it, it's not like that. It's not like, and that evaluate compared to a way to compare it against investments, and hopefully that'll help make a little bit more sense. So starting at retirement's doorstep at age 65 with $621,000 of cash in their account, they also have a death benefit of $1.246 million. Very important, because if you decided you didn't need life insurance at retirement, then your assets become your insurance. And here's a hint: assets make terrible insurance. But Jim and Judy are good. They've got insurance. If anybody dies early, then this comes in and it saves the day. But for the most part, we're going to see how this money spends. And this is where the aha moments are going to come in. So using the cash values that we showed you as collateral, they can approach the insurance company and ask for advances each year on their death benefit. And with this particular policy, they were able to withdraw $51,673 per year net of all taxes, because remember, this is tax exempt. So we funded it to age 65 with $31,000. In our retirement years, we are now taking $51,000 per year from age 65 to age 85. So that's over $1 million. Remember that 4% rule? You know, that if we were going to try to do this with investments, we sent in $557,000. That would give us about $22,280 gross. What if it was $1 million? Well, $1 million in the 4% rule still only produces us $40,000, and that's gross. We still haven't paid taxes. And then the big number is, how high would I have to go to get to that $51,000 that I earned in my strategy? So this is $51,000 per year gross, would take a portfolio of $1.3 million. So things to understand here. These guys spent their death benefit while they were alive. Together, they spent the $1 million tax-free across retirement. And let's figure out, did they reach their objectives, right? So they came to us for a 6-figure retirement income that they got to keep. The cash flow that we were able to drive from a policy, $51,000, when added to their Social Security, gave them a 6-figure income with no taxes and no offsets to this balance. So we got our 6 figures, and we get to keep all of it. No stock market risk, no advisory fees to pay to anybody, no Social Security confiscation. We don't even need to file a tax return if this is how we're set up. The remaining death benefit that we didn't spend while we're together goes to the surviving spouse, and there's a lot of reasons why you'd want to have that money as well. That's not what we're here to talk about today. But we think Jim and Judy did a good job. If you do, then we're probably in the same ball game. Now, going back to how do I compare this to investments? The way I would do that is I would say, well, what rate of return would they need to earn on their pre-tax savings to match our strategy's cash flow in a 37% tax bracket? So if we're trying to save using investments to be able to withdraw a safe withdrawal rate in retirement, how would that look? Well, let's start by working our way backwards. We're getting $51,000 of cash flow. If we gross that up, then that would be the same as taking $82,000 out of a pre-tax account, right? So if I took $82,000 out and I paid 37% tax, I would have $51,673 left over. Okay, so we're just going backwards and figuring out how big would the withdrawal need to be. Now from there, if that's my withdrawal, and we know that 4% is kind of the safe withdrawal rate, how big would that make my portfolio? So this means I would need to have a $2 million portfolio in order to be able to withdraw it safely at 4% to get the 82 a year to pay my taxes, to get to the same cash flow that we got with Jim and Judy with our portfolio strategy. So $2 million is required. Remember, they had 15 years and they had about $31,000 to save. The math of this one, folks, they would need to earn 16.8% every year while they save for retirement and throughout retirement to hit these numbers. Now, I don't know if you know people who get 16.8% year in and year out. I personally don't. And I would tell you most money managers don't either. And I would also tell you that this was the reason I dropped my securities license. I used to manage portfolios and I used to charge a fee. When this was explained to me this way, I could no longer, in any type of good conscience, put my clients' money at risk in the casino that we call a stock market, leading to an unknown tax situation. It's just not a game I want to play anymore. This is a game that we could play, and we can outperform most of your neighbors that are trying with investments. You just can't get there from here. So hopefully this is a big aha for you. This was a huge aha for me. You don't need a pile of money. You don't need an army of professionals. I think a lot of people think, well, I've heard of that before, but it's only for rich people or the connected class. And nothing could be further from the truth. The rich absolutely use this approach to money. No question about it. But we're bringing it to Main Street. And it works just as well in Main Street as it does for the ultra wealthy. In our tax code, we start with double taxing you at about $32,000 of income in retirement. That's when Social Security starts to become taxable. This affects most of you on this call. So if this is you, we're going to want to talk. You don't have any control over your future tax, and you expect them to go through the moon. We all do. If you see the national debt, if you see where we're headed, taxes have nowhere to go but up. And our strategy doesn't require investing research and stock picking and market timing, paying an advisor team and hoping it all works out. I watch lots of people do exactly that. That is not what we're here for. This is the perfect strategy for middle-class families to break out and create dynasties of wealth that they would have never had otherwise. The system isn't built that way unless you understand these concepts. A lot of us need to know that everybody's doing it the same way, or we're in the crowd. We're doing it the way other people are doing. And I'm here to tell you, you cannot spend that affirmation. Everybody getting together and telling you, great job on your 401k, you were up 10% this year. I promise you can't spend that. It's not going to put food on your table. If you want what few others have, if you want a tax-free retirement with no worries and concerns about what goes on in the tax code and what goes on in the market, if you want all that, you got to be willing to do what few other people are willing to do. So this is probably a lot of it drinking like out of a fire hose for the last few minutes here, but you may not know anybody who's done this. This may sound crazy to you. And if, why are we talking about life insurance if we've paid our house off and our kids are grown, right? Those are all the standard objections to understanding how this works. People are going to think that we're crazy. Why would you do that? You should be investing. And they just don't get it, but it affects us. And the truth is this has been used for decades. Wealthy families, lots of people have used these strategies to protect and grow their legacy for a long time. It's just not very well broadcasted to mainstream America. I believe that the triple tax-free treatment of life insurance makes it an ideal vehicle for where you want to store your wealth, use your wealth, grow your wealth, and eventually transfer your wealth. It's the perfect situation. So you don't have to love life insurance like I do. You just need to like it more than paying taxes, if that's fair. So who's done this before? I'm just going to give you some examples so that you don't feel like you're alone. These are all different people who started their businesses through loans from their life insurance company, from their life insurance policies. J.C. Penney. McCain launched a presidential campaign, borrowed funds from his life insurance. Pampered Chef. The Rockefellers are probably the most popular for using life insurance to create dynasties, just one generation after the next. No taxes, no market, just lots of life insurance. Jim Harbaugh, coach of the Michigan Wolverines, takes a big part of his pay every year in the form of a life insurance premium from his employer. Very innovative, very cool. You should look it up if you have any questions, but it's a great way to pay somebody, and then Michigan gets all their money back at the end. Very cool. Walt Disney also launched from a life insurance loan. And then last but not least, because of where we are today, this guy knows a little bit about it. He's been in the government since 1973, and he's pretty intimate with current tax policy and where things are going. He's been a part of the discussion for as long as we've been around, for many of us. He stores the vast majority of his fortune inside of life insurance contracts. And just a quick Google of his presidential financial disclosure will show you that he's got about six or seven, depending on the disclosure, whole life policies. And the rumor on the street is there's several millions of dollars in these policies, with no place to put them on a tax return when it comes time to spend the money. Pretty good scenario. If we look at this approach, doing it this way, you can get rid of things like required minimum distributions, income taxes, tax returns, your investment advisor who's charging you all that money, your CPA. We don't need a CPA if our system is as simplified as we've shown you. Your estate planning attorney. These are all places where people spend thousands and tens of thousands of dollars. We can get rid of it. And that'll save you. You don't have to pick investments. You don't have to lose money every time the market does. You don't have to pay somebody advisory fees, accounting fees, legal fees, even though you're not getting the success that you were hoping for. You don't have to lose $300,000 to Social Security tax. You don't have to lose $300,000 to Medicare. There's also $300,000 if you bring $1 million portfolio to your money manager and pay a 1% fee over 30 years of retirement. So that's another one, if we were wondering where about the $1 million goes. So what is this worth to you? If we were able to build a 6-figure retirement income that you got to keep, what would that be worth to you and your family? So if all we did was just save you from the Social Security tax, the $300,000, would that be worth a phone call today? All right, if we set you up where you were no longer giving 25% of your cash flow away in retirement to your investment advisor, if we could figure that out, is that worth a phone call? Or what if we could just create a tax-free legacy for your family? Hopefully I've brought you some aha moments. Hopefully they've inspired you to act. You've got 2 ways to do this. You can go back to what you were doing before you were watching this video, or schedule a free coaching session with me. Change the course of your life. This is a crazy busy world. You just gave me a lot of your time, and I value it, and I appreciate you. Good on you. Follow through. Book a call, and let's change your life. Have a great day.